Recently, the topic of the failed internationalization of the RMB has become a hot topic in public opinion. On June 19th, SWIFT released the latest RMB Tracker data showing that in May 2025, the RMB's share in global payments by value was only 2.89%, ranking 6th, which even falls behind the Canadian dollar's 3.11%. This figure has significantly dropped from 4.13% in March and 3.5% in April. The RMB has been overtaken by both the Japanese yen and the Canadian dollar, falling out of the top 5 global currencies. This marks a significant setback in the RMB's internationalization since it began in 2010. The last time it dropped to 6th place was in 2015-2016, which essentially is like knockback to the standing of 10 years ago. In May, the total RMB payment amount decreased by 23% compared to the previous month, while the total payment amount of all currencies fell by 6.81%. The US dollar remains the most active global currency, with its international payment share dropping from 49.7% to 48.5% in May. The euro rose from 22% to 23.56%, and the British pound rose from 6.5% to 7%. Capital doesn't lie. The continuous decline in the RMB's share and payment amounts in the international payments indicates a lack of confidence in the RMB as a currency for trade, investment, and reserves in the international market. It highlights concerns about China's overall economic slowdown. This is undoubtedly a heavy blow to the Chinese government's ambition for RMB internationalization. So why has an RMB's decline been so severe? Data shows that the turning point in the RMB's deterioration in international payments occurred in April, coinciding with the tariff war initiated by US President Trump, which drastically reduced international demand for the RMB. RMB internationalization requires a stable external environment and good relations with major economies, especially with the US. As US-China decoupling intensifies, global confidence in the RMB is waning, and the risk of holding RMB assets continue to rise. This geopolitical pressure further limits the international acceptance of the RMB. In comparison to 2015-2016, the RMB also once fell out of the top 5 global currencies. However, the reason back then was an RMB exchange rate reform initiated by China in August 2015. The control over the RMB to USD exchange rate was relaxed, allowing the daily reference rate to be based on the previous day's closing price and market maker quotes, with a floating range expanded to 2%. The relaxation of RMB controls made many see the opportunity to transfer assets out of China, so they rushed to convert RMB assets into US dollars. At the same time, some took the opportunity to short the RMB, causing exchange rate to plummet. In response, the People's Bank of China used a large amount of foreign exchange reserves to stabilize the RMB exchange rate, reducing China's foreign exchange reserves by about 1 trillion USD from the peak of 4 trillion USD. At the same time, the Chinese government launched a crackdown on asset transfers. Overseas acquisition projects by giants such as Anban, HNA, and Wanda were halted. Although the RMB exchange rate was eventually stabilized, capital control and exchange rate manipulation limited the RMB's free circulation and market-based pricing, weakening its appeal as an international currency and causing it to temporarily fall out of the top 5 global payment currencies. An obvious issue is highlighted. China's wealthy individuals and corrupt officials prefer the US dollar. Whenever possible, they will certainly exchange their RMB for US dollars. How can you expect others to trust the RMB more? However, at that time, China was still in an economic uptrend, and the Chinese Communist Party's Belt and Road Initiative was booming overseas. The Chinese government forced partner countries to settle investments and trade the RMB through various sales binding measures, causing the RMB's share in global payments to gradually increase. However, this situation is entirely different. The decline is more severe. US-China tensions have increased, China's economy is slowing down, and more seriously, the Belt and Road Initiative is facing setbacks. Some countries have reduced participation due to concerns about debt traps, slow project progress, or geopolitical pressures, even directly withdrawing. These factors combined have directly weakened the demand for RMB in cross-border trade settlement. Some even point out that the CCP's ambitions to plan to have the RMB replace the US dollar and achieve internationalization is likely to fail again. Another manifestation of the setback is RMB internationalization is its exchange rate fluctuations and depreciation pressure. In 2025, the RMB USD exchange rate fluctuated between 7.1 and 7.4. On April 8th, the exchange rate briefly reached 7.4, hitting a 19-month low, and the topic even trended on Chinese social media. Many analysts believed this was due to the Chinese government's intentional manipulation of the exchange rate. Due to the resumption of the US-China trade war, the government viewed the RMB depreciation as a strategy to boost exports and relieve pressure from tariff increases, while attempting to use RMB appreciation as a new bargaining chip in negotiations with Trump. Due to obstacles in exports of the US market, Beijing has started to lower the RMB exchange rate against various non-USD currencies to enhance export competitiveness, while attempting to maintain the relative stable of the RMB USD exchange rate. According to data from the China Foreign Exchange Trading System managed by the People's Bank of China, the CFETS RMB index fell to 95.49 on June 13th, the lowest level since December 2020. As of June 20th, the index has slightly rebounded to 95.92. Since the beginning of 2025, the CFETS index has fallen by about 5%, significantly lower than the end of 2024 closing level. The CFETS index measures the RMB's exchange rate performance against a basket of 25 currencies. Recently, the RMB has depreciated against 19 of these currencies. Notably, the RMB has depreciated by nearly 10% against the euro since the end of 2024, dropping to 8.44 at the end of April, and the lowest level in 11 years before slightly rebounding to 8.2. The RMB has also shown a trend of depreciating against the Thai baht and other Southeast Asian currencies. In early June, the US Department of the Treasury published its semi-annual currency policy report. While it did not designate any trade partner countries as currency manipulators, it added mainland China, Germany, Singapore, Vietnam, Japan, South Korea, and Taiwan to the watch list, with Switzerland and Ireland also newly added. Brad Sester, a senior economist at the New York-based Council on Foreign Relations, wrote that the latest report promises that the Treasury Department will make technical adjustments to its algorithms, something that it should have been done earlier. This potentially increases the likelihood that certain countries or origins, especially China, will be labeled as currency manipulators. Once the US labels China as a currency manipulator, a currency war may begin between the US and China. The US may use its advantage in international finance to launch a full-on attack against the RMB. Clearly, China currently dares not recklessly devalue the RMB against the US dollar, and instead focuses on manipulating the exchange rate against the euro and 19 other non-USD currencies. It seems that faced with the US as a top valued, the CCP remains cautious and targets softer targets to maintain export competitiveness. The payment system proposed by China for the BRICS countries involves two currency pools, one for gold and one for local currencies. An initial contribution is set, and adjustments are made based on monthly trade surpluses and deficits. It looks good on paper, but upon closer inspection, there are many issues, such as: first, which system will be used? Will it be led by China or by Russia? Will other countries agree? Second, how will these currencies coordinate their exchange rates? For example, the Brazilian currency has depreciated significantly against the US dollar due to severe domestic inflation in recent years. Is the CCP willing to lose money for the sake of publicity, and will other countries agree? In reality, most of the surplus countries such as Saudi Arabia and the UAE prefer to accept hard currencies like the US dollar. So the internationalization of the RMB is hindered by internal conflicts within BRICS, geopolitical pressure, and concerns among member countries about China's intentions. making it difficult for the RMB to become an effective platform to challenge the US dollar. Previously, China and Brazil announced they would abandon the US dollar for trade settlement and use their local currencies instead. This was hailed as a major breakthrough in the internationalization of the RMB and a challenge to the dollar's status as the global reserve currency. However, the final result was merely a financial gimmick using local currencies for settlement. Brazil's situation is quite unique as it is the only country where China has both a trade and investment deficit. China imports large quantities of iron ore and soybeans from Brazil, but exports less to Brazil. According to data from 2024, China's trade deficit with Brazil amounted to 313 billion RMB, making Brazil China's third largest trade deficit country. At the same time, Brazil is China's largest investment recipient in Latin America, particularly in high voltage transmission lines and oil extraction. This creates both a trade and investment deficit. As a result, Brazil has accumulated a large amount of RMB that has no use domestically, so it can only invest in China. Since the RMB is not freely convertible, it must be exchanged through specific channels to invest in Chinese bonds or the stock market. As a surplus country, Brazil may theoretically choose to invest in Chinese government bonds. However, the yields on Chinese government bonds are much lower than those on US government bonds or the same maturity, and the RMB faces depreciation pressure against the US dollar. Rationally, Brazil is more likely to exchange RMB for other currencies at offshore centers like Hong Kong. After going around in circles, the RMB's dream of internationalizations and replacing the US dollar has in fact become a test of the offshore RMB exchange rate. So, while local currency settlement seems glamorous, it actually exposes the core dilemma of RMB internationalization, a lack of free convertibility and market trust, making it difficult to truly challenge the dominance of the US dollar. Recently, the rapid development of stablecoin linked to RMB internationalization has garnered widespread market attention. At the 2025 Liu Jiazui Forum, the governor of the People's Bank of China, Pan Gongshen, mentioned stablecoins for the first time, calling them a bridge between digital finance and traditional finance. However, for China, the development of stablecoins may challenge domestic capital controls on cross-border flows. So the Chinese government has chosen to test issuing stablecoins in Hong Kong, a place it can control as part of its long-term strategy for RMB internationalization. It aims to bypass SWIFT and the US dollar settlement channels and integrate into the global digital financial ecosystem. The Hong Kong stablecoin ordinance will take effect on August 1, 2025. The ordinance applies to stablecoins that keep their value by referencing the HKD and currencies of other major global economies. Hong Kong's Financial Secretary Paul Chan described Hong Kong as the firewall and testing ground for RMB internationalization. Hong Kong, as the world's largest offshore RMB trading center, handles approximately 80% of offshore RMB settlements. It has mature financial infrastructure, making it suitable for testing RMB stablecoins. The stablecoin will be pegged to the Hong Kong dollar, but will actually be backed by offshore RMB reserves to ensure currency stability. In the future, it could support Web3 project financing and cross-border settlement, promoting the RMB's integration into the digital financial ecosystem. However, analysts point out that this plan faces multiple obstacles and may not achieve the expected results. First, the stablecoin project in Hong Kong is still in its early exploratory stages. The asset custody, exchange processes, and pegging targets are unclear, and the system risk cannot be ignored. Second, from the design perspective, the Hong Kong dollar stablecoin appears to be compliant, transparent, and technologically advanced, but the real challenges are stark. On-chain activity fails to address off-chain issues. The use of the Hong Kong dollar is limited, and the contradiction with the USD-linked exchange rate system may undermine the foundation of the Hong Kong dollar's credibility. Economist and senior Taiwan political and economic commentator Wu Jialong pointed out that the CCP's optimistic attitude towards RMB internationalization is self-indulgence and self-deception. Currently, China is mired in a technological debt trap and an expanding government debt crisis. Relying solely on small-scale opening measures is insufficient to enhance the RMB's position in international settlements, let alone challenge the dominance of the US dollar. First, RMB internationalization requires the realization of free foreign exchange trading, but the CCP's strict capital controls limit the free convertibility of the RMB. Wu stated that if these controls were loosened, the Chinese public could convert large amounts of RMB into US dollars, leading to capital flight. So the Chinese government is unwilling to ease control. Second, RMB internationalization requires support from a modern bond market, but China lacks a credit rating mechanism like Moody's or S&P. Government bond yields are low and the RMB faces depreciation pressure, making it difficult for foreign investors to feel secure about investing in Chinese bonds. Moreover, the US exports dollars through its trade deficit and has become the global financial leader. China, as a trade surplus nation, lacks the motivation to export RMB. Wu questioned how China could maintain a trade surplus while also wanting to lead free trade. This is logically contradictory. In fact, the RMB's share in global foreign exchange reserves has never exceeded 3%. As of the fourth quarter of 2024, the RMB's share in global foreign exchange reserves was only 2.18%. However, as the world's second largest economy, China accounts for 18.5% of global GDP. This disproportion indicates fundamental flaws in China's financial system, which has yet to integrate with the international financial system. China's financial system is still heavily controlled by central policies, and the CCP's regime is highly distrusted by the international community. So, without fundamental changes in these areas, the Chinese government's loud calls for RMB internationalizations are nothing but self-inflicted humiliation.